I would say, yeah, this is the most recent. This is in August 2020. This is a property I own up in Fort Worth. So I figured I'd just go and pull a financial statement. You guys could see the real deal from an actual property, and one that I know at least a decent amount about and can share with you guys. So this is a T12. It's structured month by month, 12 months, and then you've got a total column at the end. You've got all of your different categories from your ledger. It starts with income. The income section is up at the top. You've got, rental income, adjustments and losses, other income, and then you have your total income or total revenue figures. And then the next section of a T12 is always the expenses, which we're not going to get too much into today, but just to show you guys a bunch of different categories of expenses, obviously, and all of these flow down into the all-powerful and almighty net operating income that we're always looking for. Right, that's the most important number for us, or one of the most important numbers, because that number is what drives the value of this property. Right, I guess, let me see, I haven't done this in a minute on this property. We've owned it for about 1.5 years, but if I look at this property at a 6 cap, 638,000 NOI divided by 0.06, the value of the property is 10.6 million. And I bought this property for a little over 8 million. So you can see it's gone up almost 2.5 million in value in a 1.5 years. Now, how has that happened, right? That's crazy. How do you just create 2.5 million in value out of thin air? And that's at a 6 cap. I think honestly, this market's probably like a 5.75 for this type of property. So how does that happen? Well, revenue. Revenue is the driver for all that. Although managing expenses is extremely important, expenses will stay fairly static. And what really drives the NOI growth is that revenue factor, right? It's very important. So what are the components of revenue? I think I mentioned it a little bit before. We've got, can you guys see all this, these numbers too? It's not too small, hopefully?
I can see it, yeah.
Yeah, I can see it, no problem.
Okay, awesome. So the 3 main sections, and sometimes it's 2 sections, these 2 might be combined. Sometimes it's 1 section. Sometimes you don't get this much detail and there's literally just 1 column that says income, right? It depends on who you're getting the document from. Our management company is pretty detailed, so you can see this is the whole income section. It keeps going all the way, from here all the way down to our total income, which totals all that. So the main section you're going to see in a professional T12 is the top line is gross potential rent. And that is a number calculated based on what we are determining the market rent of every unit in the property totaled up every month. And that's adjusted based on, you could see this is kind of going up, and that's because we've renovated a lot of units at this property. So every time we renovate a unit, the market potential for that unit goes up. And so that's calculated. And you can see, it started off here, it's a little higher here. And then what happens is this number, this gross potential rent, is essentially the number that we would collect if all of the units were 100% occupied for the month and we collected all of that rent. And so obviously, multifamily isn't that perfect. We almost never collect 100% of the rent every single month on large properties like this, right? There's always different things, concessions and losses. And so what we do is we start with the top line number of what's our potential, but then out of that, this next section is adjustments or losses, or, they're called different things, but what they are is a couple different items that we subtract out of that gross potential rent. And I think this subsidy line item, just if anyone has a question on that, that's just 1 unit that might be a subsidized rent payment. So they separated it out. To me, I don't really need to see that separated out. I might ask them to combine that back into there, but just in case anyone had the question. What you'll see in these losses and adjustments is a couple things. In my opinion, there's 4 main ones, but there are a few additional. The 4 main ones are going to be, obviously the biggest one everyone knows is your vacancy loss. So what we're doing is we're saying, let's say back in September, we'll start in July because that's where we're at now, or August. In August, we had $116,040.10 in potential rental revenue. If we collected all of the rents from all the tenants and there were no vacant units or anything, everyone paid, that's how much we would collect. Well, that's not the case. We had some vacancy loss. And so that's recorded as a negative on here and on most professional T12s. Vacancy loss is probably the most common one that you guys all know about. The next one is going to be loss to lease. That's another common one. What loss to lease is any resident that, it's actually the difference between the market rent that you should get and what is actually charged to the resident per their lease agreement. So let me give you an example. If we have a unit that's supposed to rent for $1,000 and it actually rents for, and we end up leasing the unit and signing the agreement for $950, but the market rent's $1,000, we're going to record $50 a month in loss to lease. Loss to lease is the difference between the market rent we set and the actual lease rates that we're getting. So, you might have some overs, you might have some under, and balances out, but it's recorded on here every month as an adjustment. Then you get vacancy loss. Next thing, the next big one is concessions, which I really like, but we don't give a lot of concessions here, and I'm glad about that. But concessions are one-time discounts to rent. So, for example, move-in special. You move in, you get $250 off your first month's rent, or maybe you really need to lease units. You move in, we'll give you the first month for free. That would be recorded as a concession that month that the concession was given. And it looks like we don't give any concessions. So let's see, bad debt is the fourth major one. And what bad debt is, it's recorded when we determine that rent is no longer collectible. And we put that here as lost revenue. So bad debt meaning, hey, somebody moved out, they owed us $500, security deposit doesn't cover it, or they didn't have one. We write that off and record that as bad debt, meaning that we do not believe we'll be able to collect that. And so that's what goes there. And there's a couple other ones here that you can see that are ancillary. They're not as common. You won't see them everywhere, but you got a model unit perhaps, and we're recording the loss there for the model unit. It's not collecting revenue, so obviously we're not gonna, we're gonna take that off the top line. And then we've got what's another one? Employee discounts. So employee discount on rent, we're recording as a loss. So hopefully that makes sense. We're starting with the top line. What's our potential? We're deducting all these items out, and that gives us our total rental revenue. So this is the amount we're actually collecting every month after all these the write-offs and the losses. This is what we're getting in rental revenue every month, and that's what we're recording. And so this is on an accrual basis for accounting, which I don't think we need to get into specifics of that. But
hey, David.
Yes.
So we just have a question in the chat.
Oh, cool. I don't have it open, so sorry. I didn't see that.
Joseph Wang.
Cool.
Gain to lease, loss to lease. Who determines the market rent? Is it rent-a-meter? Why not have the same lease amount for the same square foot unit?
Yeah, good question. So in the property management software, what we do is you add all the unit types into it, and then we set a market rent. And that market rent really changes a lot with the market. So, let's say the market's improving, we'll maybe meet with our management company every couple months and adjust it. Maybe it's gone up $25, maybe it's gone down $20 in the winter, who knows. However, that's set between us and the management company. And so when we set that in the system, our leasing agents see what our market rent is. Their goal is to lease units at that rate. However, sometimes they get, discounts approved, and maybe they give somebody $25 off the market rent that they're supposed to go get. Maybe they're having trouble getting it. And so they lease a unit for $875 instead of $900. And so, that's why this is constantly changing, this top line potential. And then the loss to lease is just the adjustment for what, they're actually leased for, the difference between the market rent and what they're actually leased for. So hopefully that makes sense.
Thanks, David.
No problem. Yeah, just ping me. I don't know if I could, let me see if I can pull up the chat. I don't know how to do it. Sorry. It goes away when you screen share. So that's kind of the top section here, guys. Next is, and the last section really is other income. So there's a bunch of different items that can be in here. Some are more simple than others. Sometimes you might just see like other income and then utility reimbursement income, and that's it. And then sometimes like ours, you see 50 different things. So all of these give us ways of generating more and more revenue. And as you can see, it adds up quite a bit. We had $32,000 in late charges in the last 12 months. If you calculate that at a 6 cap, what is the value? Because like I said, the income, the net operating income is what helps us value the property. You divide it by a market cap rate. Like it's almost like in, other industries, you might have a multiple of your revenue. It's a 5x on revenue is what the value of your company might be. Well, in commercial real estate, as most of you guys know, or if you don't, we use cap rates and you divide by a percentage, typically in the range of like 5 to 10%. The hotter the market, the more aggressive it is, the more demand, the lower the percentages, meaning you're going to get a higher valuation for the same net operating income. So quick rundown on NOI, but that means each one of these items really has a value to it and adds value. If we didn't have that $32,300, our property would be worth about $533,000 less at a 6 cap. So adding these ancillary streams of revenue adds a ton of value to the properties. So it's really important to have these. And so a good management company will be charging all these, collecting them, and implementing, different fees and other income in order for you to, improve and increase your revenue. Opportunity fee, I don't even know what this is, to be honest with you. I'd have to ask them, but we made $11,250 off of last year, and I like that. So
Great job.
I'm gonna have to figure out what that one was, but get back to you guys. But bad debt collection, that's where we collect on the write-off up here. Pet rent, you have a pet, we collect pet fees. Oh, sorry, right down here. Oh, that seems pretty low. There might be another one where, pet fees, there's another one. They've got 2 lines. They probably should combine those. And then
David, those are typically like a one-time fee initially and then recurring monthly rent, right, for the pet?
Yeah, the pet fee is the one-time thing, and then the pet rent usually is the monthly recurring one.
Gotcha. Yeah, that makes sense. Pet fees up front, pet rent is the monthly. Yep, exactly. You guys got it. And so sometimes you see it combined, sometimes you'll see it separated. Perfect. Early termination fees, that's pretty self-explanatory. Fee for somebody getting out early. Cleaning fees, damage, miscellaneous key cards. Believe it or not, I've seen properties that make a couple $1,000s a year just on, charging tenants for new keys. So that does happen. One of the biggest ones, in my head, I kind of group all of these into one. This to me, from suite rental all the way up here, this is other income. And if I were to total all that, I could say, let's just try this real quick. 159,000. I'm going to subtract out these ones to kind of get our total. We got 62,000 minus 9,775 minus 2,250 minus 11,000. 70. Let's just say 74,000 in other income. I'm separating out this utility reimbursements here. And so this is 136 unit property. So we have $544 just per unit annually, just in other income at the property. And that's fantastic. I normally see other income, not including utility reimbursements, in the $300 to $500 range. So 544, that's a great number. I know that we're doing well based on market averages that I see. So it's good to know that, because when you guys go and you're putting a pro forma together and you're budgeting, I normally I don't get as detailed. And I think anyone who does is, doing too much. And that's coming from an analytical person. I don't go in and budget. The management company does. They budget what they think they're going to make on each of these. But in my pro forma, when I go to make an offer, and I'll show you in a sec, I don't budget what I think each of these are going to make, each line item. I will just put in a general per unit amount, and I'll say, I think that the property is going to make, $400 per unit times 136 units. So I'm going to budget $55,000 a year in other income. And that's kind of as simple as I really get, guys. anticipating other incomes, I just use a general per unit, and that's conservative, right? I use, somewhere between 350 and 450 because I don't want to overshoot. I'd rather undershoot. And then, like we did here, we came in high at about 550 per unit, another income. And so I just lump all those together in my projection. And then I have separate utility reimbursements, which is, I think, when you talk ancillary revenue, there's a bunch of different ways, and I'll maybe throw out a couple other examples, but utility reimbursements is the biggest one that you guys can go in and implement right away that is going to generate a ton of income for you. So I think we said $74,000 for this. So if we have 159,000 minus 74,000, that's about 85,000 remaining in the utility reimbursement income. And so what this is, utility reimbursements, or commonly referred to as RUBS, R-U-B-S, I think it's ratio utility billing system. There's a couple different ways to define the acronym, but it's a way that we as property owners can bill back utilities without having to individually meter the actual utilities themselves. So for example, this property, 136 units, there are, I believe, 10 buildings at the property. You might even be able to see it here. This is the property right now. It's called Cobble Hill. 1, 2, 3, 4, 5, 6, 7, 8, 9 buildings, 10, 11 buildings. We have 11 water meters. I'm just going to say, I'm assuming there's around 11 water meters. There's one per building. So this building right here has 30 units, let's say, and 25, 30 units, but there's one water meter. So we get one bill at the end of the month for that whole building. Now, what we do is we take all the utility bills that come in and we put them in our software, and it has an equation that will bill back pro rata share to each unit, to each resident, based on the square footage, the number of residents in their apartment, and the number of units of the property. It'll divide that up. So and then we'll take off the top. I think in Texas, you can only charge up to 80% of the total utility costs back to the residents. So we'll charge, 80% of what that cost is back to the residents. So one way that you can calculate that going into the property is, let's say we look at a T12 from a seller. Let's go on down. Oh, it's right at the top here for us. That's perfect. For utilities, we're spending $72,000 a year in water bills at the property. And so I can go in and I can say $72,000 a year in water expenses. Well, I plan to bill back 80% of that if they're not already doing it. And then we'll anticipate, around $57,000 a year is what I'm going to budget my pro forma for what I'm going to bill back to residents. And that per unit is about $423, or if you're looking monthly, about $35 a month per resident they're going to be paying on top of their rent. So, that's kind of quick math, quick calculation of what you can do. It looks like we're charging a little bit more than that. Maybe it's just a timing thing. It looks like one of these months this was kind of low. I'm not sure why, just timing. So, utility reimbursement is a really great way to add value back to the property. I mean, I think we were talking 85,000 in income. That's at a 6 cap. That's $1.4 million in value that we added to the property that wasn't happening before. So, awesome way to add value. Utility reimbursements. Basically take master metered utilities and put the responsibility on the tenants to pay it. And then you do the same thing. Look, we're doing it with trash. We're doing it with pest control. We're doing it with gas. It's not just electricity, which is individually metered already. So awesome way to do that, bill back the residents. And then all those flow down to the total income. We have any other questions so far, Nick? We're doing good at that point?
We have a new question from Ray. He's asking, is property management a percentage of only rental income, or does it also include other income plus utility reimbursement?
Great question. I would say 95% of them, they're calculating it based off the total income, gross collected income every month. So they're looking back and they're saying, okay, we collected $124,980, $124,980. Or maybe I can give a better scenario. I can actually calculate one that you'll see in July, 12719 times, I think we're paying 3% of this property, 3621 or 4225. It's one of the two. So it's calculated off that, and then we'll go down here and we'll look at management fees. 3505. So 3505 divided by 12719. Yeah, just under 3%. So they're charging 3% of the total income as their fee, and that's pretty typical. They're gonna take their percentage of other income and rental income, everything. So good question.
Well, I have another question.
Sure. What's up, Joseph?
So you're mentioning about the RUPS is $85,000. Nevertheless, if you look at the operating expenses, both water and gas itself is already 86,000. So does it mean we lose money here?
So great question. This is how I look at it. So let's say we bought the property and they weren't charging any of this back. So, you know, a lot of times, let's say, for example, you rent an apartment and your rent's $1,000 a month, and they tell you, you pay your electricity, we'll pay your gas and your water, right? That's pretty, you know, that's common.
Right.
Now, not as common nowadays, but it was common. So what we're doing is the landlord, we are, you know, spending this $72,000 a year and not getting any of it back. So we're pretty much with the reimbursement. It is what, you know, kind of as the title suggests, we're just being reimbursed our costs. So technically, we're not adding, I mean, we are adding value by doing that, but we're just reducing our loss. Technically, we're just reducing our expenses by as much as we can. Does that make sense?
Yes, got it. Thank you.
Also, you're
No
not able to
problem.
build back sort of common areas and stuff. So that's also the reason why it's not going to be exactly there.
Exactly. Yeah. There's normally 15-20% for common areas too. Yeah. That's a good point. So yeah, we're with the reimbursement, utility reimbursement. It's, you know, it's income that we're receiving, but really just, we're trying to mitigate our loss and minimize the amount that we're paying in utilities. Yep. So that's a good point. So a couple things I'm looking for here, guys. I'm looking at side to side. You know, in T12, this is hugely important. I'm looking side to side from left to right. What's happening? So there's a couple things, right? If I were to look at this and I didn't own this property, but if I were to look at this as if I didn't own it and I wanted to buy it, there's a couple things I would notice. Well, first thing I'd notice is this potential rental income is increasing every month. And I think I pointed that out before. So I could infer from that either the market is growing quickly, which that would be a pretty quick growth for, you know, that's what, 4 or 5%, 6% in a year almost, which would be really high growth just on its own, or they're renovating units, which is what we're actually doing in this case, you know, or let's say the prospective seller is renovating units and that's why the income's going up. I would also look at things like my bad debt. Is this going up or down? Maybe they're increasing rents a ton, but also as they're increasing rents a ton, their bad debt's going up with it. And so they're increasing rents, but they're not screening their tenants well. And so they're actually not ending up collecting as much. And so maybe you look at this rental revenue and it's not really trending up that much. And in our case, fortunately, we're doing really well at this property. And you can see even through COVID, March, April, May. I mean, here's a COVID example for you. We actually went up in April, May, June, July, and August, and we've had our best several months through COVID. Most of our tenants are still employed, fortunately, at this property. So, and so we notice here, you know, there's been a big jump, and the average in the last couple months has gone up quite a bit. So, so that's a good sign. I mean, as a buyer, I really would prefer it to be pretty stable and stay low so that I can go in and add that value. But at the same time, it's good to see it trending up. It means they're able to be hitting higher rents and, you know, the area is improving and everything. You want to look at the vacancy loss too. Is this climbing? Is this decreasing? You know, it seems to stay fairly steady. There's some months that are higher, some that are lower, but nothing crazy that stands out to me. So, you know, we're looking at that. And then I'm looking at, you know, same thing for this category. Are we trending up, trending down? It looks like there's a couple lower months here. Not sure why. It's not a giant swing, but I'm just wondering, maybe you can go and find what it was. Maybe there's a couple one-off items. Opportunity fee looks like that kind of dropped off here. And so, you know, we had a couple lower months. So, you know, you're just looking around at a couple different things and seeing You know, it looks like, see, that's weird here. We had 6,100 in water reimbursements, and it kind of trends down a little bit and has really hit a low here. There must have just been 1 month where a lot of people didn't pay them, or something happened that was weird. So, and then in the end, we're just looking at total income. What is trending up? What's trending down? Is it not moving? Do we have one really bad month? If so, what happened? I mean, these financial statements tell a story. I've seen ones where, okay, you get to February, everything's good, and then March, we're at 65,000. What happened? Oh, there's a fire. They had to move 2 buildings out, and 40 residents left the property. Okay, well, that's something that a financial statement could technically tell us, or at least allow us to raise the question to the sellers or the broker on why that is happening. So I think that kind of summarizes revenue here for you guys on an actual financial statement. Let me show you my financial model really quick how this works. So I input all the T12 numbers. That's what's going to show up here in a year by year format instead of month by month now. And then on my inputs, not to get too deep into the spreadsheet, I'm inputting what my rents are and everything, and what my expenses are going to be, and that kind of flows through to the sheet. So here going forward, as you can see, I'm calculating and putting in a projection number for what are my utility reimbursements, what are my other income going to look like. These are lower than what they actually were, so I'd probably want to go in and adjust these. I'd probably want to match a little bit more closely what they've got, so I can go into my other income here and do 90,000. I think would be a little bit more reasonable, and maybe 50 bucks a unit. Gets me a little closer to where they're at. Normally, you're gonna trend in a pretty similar fashion to the property that you're in, the condition that you're buying it. Hopefully, you take it and you do even better. But I like to be conservative. So, and then we've got all our standard loss to leases that we can adjust. And maybe in the first year we've got a lot of renovations going on. So I might not anticipate a really good occupancy rate. I might say, hey, 15% vacancy loss or 12% instead of our typical 5 or 6 at stabilization that we get down to. So, this is all adjustable, and hopefully you guys have a financial model that works for you guys as well, where you can play around with these things and adjust your projections like what we were showing. But as you can see, this is my whole projection section. Compared to what a lot of times you'll see is, a page and a half long. Some people get so in depth on the level of detail, and I've bought so many properties using this level of detail. I think it's plenty detailed enough, and it gets me to the finish line into a place where, I don't really need to know the 20 different categories in here. I just know that it's standard in the market to be within a certain range, and so I tend to just project out a conservative amount from that range. And so, that helps me project going forward what I might see and our rental growth, as you can see going forward, I've got a 2% annual rental increase on a couple of these, and, that's driving the growth as we renovate units as well and all that kind of stuff. So, not to get too in depth on this, I know I don't have a ton of time there, but that's kind of a breakdown of revenue. There's tons of different ways to increase revenue. I mean, you could build storage lockers on the property. Let's say you have basements, maybe you could build some chain link storage lockers and charge $50 a month per locker. A lot of big properties are throwing Amazon boxes in. They'll pay rent to put those on site on the property. You get a vending machines, for revenue sharing. There's so many different things. I've seen large properties have like daycares and there's just a million different ways you can increase revenue. Anything that you could think of that would be useful to someone, or whether it's a service or, it's just something you're doing for people and you feel like you can charge for it, try it out. And if it works, it works. A lot of times, I bet we probably get a ton of pushback on a lot of these little fees, but fees are a part of the multifamily business, and we charge them, and for our time and our services. Hopefully that gives you guys a good breakdown. Nick, is there anything else in specific you'd like me to go over in the time block?
We do actually have a question, probably
Okay.
one of our last questions, but so when underwriting, considering COVID, how are you underwriting for rent growth and expense growth?
Yeah, good question. So I'm keeping my expense growth pretty similar to where it was at before. You know, between 1 to 3%, depending on each category. I kind of can set a different percent. And so you can see percent increase. Some things like legal professional, you're not really going to see any change in that. Depending on how long I hold it. If I'm only going to hold it for 3 years, I'm really not even going to project a utility increase all the time. Sometimes I will, sometimes I won't. Income right now, what I'm doing is, this is a sample deal. This is not like a COVID underwriting, but typically I would not be having any rental growth in the first year and probably the first 2 years. However, you know, I'm closing on 200 units this week in a really solid market. And although COVID has affected, it's in Michigan, COVID's affected the state, I still know the markets well enough that I know I'm going to renovate units and get rent bumps. And I'm even charging $300 to $400 rent bumps in some of these units. And we've gotten them so far in this market. And so, you know, even I think you have to be really particular on the market you're in. Some markets I would be very, very conservative. I mean, if you want to buy in Minneapolis right now, more power to you, but, you know, don't bet on any rent growth for the next couple of years. But, you know, if you're buying in Austin, Texas, we're booming right now, and that building is going up, and, you know, units, new builds are leasing very quickly still, and rental rates are increasing still. So I think it depends where you're at on how conservative you are.
Great, thank you so much. I think we're also coming at a time. Nick, do you want to take back over and we'll show the contact slide? By the way, Nick is having some technical problems, so I'm kind of gonna speak on his behalf. So cool. I think oh, we lost the slide. So the best way to contact David.
I can throw it in the chat if you want me to. Oh, you got it there. No problem.
And then let's talk about how to best contact you. And then this is also our emails. So feel free to reach out to us either via email, or you can also go to the website, lionpartners.com/contact-us. And then David also put into the chat his contact info. Oh, Instagram, millennial style. And then also his website. Yeah, of course. We'll slide into your DMs, David.
Awesome.
So yeah, okay. I think with that said, if there are no further questions, we can actually kick off the second breakout session. All right, I think Nick, if you could work on the breakouts, that would be awesome. All right, we got a thumbs up from Nick.
Do I have you there, Nick? Oh, maybe you're on mute. I can't hear you. Uh-oh. Can't hear you. Maybe disconnect. Oh, it's not my speakers. I was gonna let you know I have a hard stop here at 9. Is that okay? Okay, I'll see you Friday, right? Friday morning? Perfect, man. Thank you again. Peace.